similar last year when there was the 12-day war. There were limited disruptions or no disruption at all. And the market will only start to incorporate this into the prices if something happens on the supply side. We also need to remember that President Trump prefers low oil prices, so some market participants still believe that he will be cautioning, but at the same time we see an increase in verbal tensions. If I listened to Vance yesterday, the US Vice President, he sounded less optimistic than the Iranian Foreign Minister. And I think we need to watch out what happens over the coming days. But what is a big difference is that the start of the year expectation was that the price will fall lower, and we are higher since the start of the year. So part of it is incorporated in the price, I believe.
Let's welcome Neil Atkinson, the former head of Oil Markets Division at the International Energy Agency, also in Europe, in beautiful Paris. I don't know why you'd be envious of anybody sitting on a beach in Sydney when you've got the Arc de Triomphe and the Eiffel Tower outside your window. Never mind the Louvre and the beautiful endless croissants. But to each their own, obviously. When you've got a six-pack like Peter McGuire, of course you're flaunting it on the beach, for God's sake. That's what you do. Neil, the reality of the world at the moment is that, at least when I went to college, if Iran ever said they were closing the Straits of Hormuz and put missiles across the water, you don't wait to wonder if supply will be disrupted. You go very, very long on oil. I mean, at the end of the day, there's a clear message coming from Tehran here, and the market seems to be, not biting on the hook. Your thoughts of the day's events?
Well, I think the market's view is that Iran can, make a gesture about a very short-lived closure of the strait allegedly for technical reasons or a military exercise. But nobody seriously believes that even if a closure were to actually happen, that, it's very difficult. We've all spent huge chunks of time over the last 40 years getting out our maps of the Strait of Hormuz. We've all learned off by heart how wide it is, how deep it is, how many ships pass through it, how much oil, how much LNG, how many tons of pistachios. And, we know that it is highly unlikely to happen. And if it did, it would be short-lived. The US Navy...
But is the Iranian message here not saying, I mean, for the first time that I can remember, listen, A, this is something we can do, or B, it is something we are willing to do. I mean, obviously one has to read the message here. It's not just happened this day by coincidence because it's a random Tuesday or Wednesday,
No,
there's a message.
I get that, but the point is, I mean, what kind of message is it? I come back to my point. Nobody seriously believes that a sustained blockage, a serious blockage, would be allowed to stand. And for Iran, it's economic suicide because, all of their oil passes through there, lots of their other trade passes through there. China is not going to be very amused at losing, 1.5, whatever it is, million barrels a day of oil. So there's a huge amount at stake here. And basically, we at the moment, we're in a situation where we go from day to day looking at news headlines. Yes, there are talks taking place. And, on Monday, everybody thinks everything's very positive. On a Tuesday, it looks less positive. Wednesday, more positive. The reality is that nobody really knows. Giovanni, though, made a really important point here, is that whatever Trump may wish for, it does not include higher oil prices. So anything that would lead to higher oil prices, i.e. some form of disruption to supply, that is a big, big no-no for him. So we have to assume that talks will continue to keep a lid on the worst possibilities of higher prices, and we'll see where it takes us.
Let's go out there to Australia. Peter McGuire, CEO, AustraliaTrading.com, formerly XM. Peter, from the distance and the sort of the clarity that comes with distance, what does the news of the day look like to you? I mean, is this a case of the market saying, as Neil and Giovanni have said, well, we don't really believe it? Or is it the market saying, not that sort of posture, as Neil said, but saying there's so much oil supply in the world today, a little bit of disruption, even if the Strait does get a little whacked, there's ample supply, ample supply. So it's more ample supply issue, 1 billion plus barrels of storage in China, 100 million barrels of floating storage from Venezuela and in Iran and so forth, that this is really the question of not interested because of that point rather than don't believe point. What's your thoughts on that?
Yeah, maybe not don't believe the hype, Sean. Good morning and greetings from Sydney. Lovely to join you all. And I think it is don't believe the hype. I look at it, remembering that you've got a lot of Asia shut down over this week and Year of the Horse is galloping away. So as we move forward, there hasn't been a great degree of, I think, volatility across equity markets today. Crude's come under a little bit of pressure to the downside. We've all seen that. And as both Neil and Giovanni mentioned, I think who's going to feel the pain more than anyone would be China and Asia. And whether I can't see it impacting America in any fashion or form. I listened to a chat the other day, second and third orders of consequences and how they roll forward if they do shut the strait. And it's really the impact is going to be squarely on the shoulders of Asia. That's where it's going to be a pain point. So I agree with Neil. I don't think that they'd shut it. And if it does shut for 24 or 36 hours, there might be a spike in energy prices, sure. But I feel as though with the armada that President Trump's got there and his mandate to keep energy prices cheap and not more expensive, they'll do whatever they have to do to keep it open. And that's going to be a real telltale sign of how protracted this could be or how short-lived this possible strait shuttage could happen.
And as we look through this immediate noise, Giovanni, of the Iran-US face-off, the talks ongoing in Geneva, and you'd have to say generally the mood music seems relatively positive. But the other issues impacting the market, most notably Russian crude flows. Of course, Russia, one of the biggest oil exporters in the world, caught in a 4-year war in Ukraine, but still managing to get its oil to the world. But increasingly, there seems to be challenges to that. How is the widening discount on Russian seaborne crude starting to shape global oil price dynamics?
Generally, I would say these discounted barrels will ensure that there is a buyer. Essentially, it's the question how big the discount gets. Yes, it has been several times over the last 4 years temporarily difficult, but so far Russia has always managed to find a way to export its crude, and the total amount of Russian crude exports have stayed elevated. There is not a big drop unless there was an attack on some infrastructure, refinery related, impacting products, or export terminals impacting exports from crude oil. But otherwise, I must admit, I didn't expect that Russian exports hold up that well. And it's probably the same way like Iranian barrels keep flowing on the market. It's the price. If it's attractive enough.
When you say, Giovanni, there'll always be a buyer at these discounts, what scale of discounts are we talking about here? And is there any other buyer than China?
On the Russian side or on the Iranian side?
Russian.
On the Russian side, it's still China is the largest buyer, but India is still also buying. There is some European countries still buying Russian oil, and then somewhere in South America and in South Africa, or in Africa generally, there is still buyers, but also some Asian countries. But the majority of the flows goes to China, followed by India, although they scaled back a bit. And the discount is probably somewhere between $5 and $10.
That's all. I mean, I was hearing in double digits, but you think it's not quite in the 10 to 15 range, more 5 to 10 range.
Probably it depends on which period. When it's more difficult, it could widen, but I would say the average is somewhere between 5 and 10.
Neil Atkinson, when you look at the fundamentals here in the oil market, we've got obviously flows troubled, the Russian flows troubled, the Iranian flows are troubled, but moving, as we've noted, for some time, and despite the sanctions. Where are we at in other fundamentals in this market? The Venezuela oil flows are now opening up, easing, moving out of the dark fleet and the dark sort of illegal sanction space into legal. Is this a tight market? I mean, one of the things I came away from IE Week a little bit sort of confused by, a lot of people saying this is a tighter market than the perceived outlook. And yet oil prices were forecasted for the year to average around 60 on Brent. What's your take on the supply demand balance looking through the sort of Iran US noise? Is this a tighter market than was previously perceived at the beginning of the year?
Well, we've had this debate now going on for some months, where in the early part of 2026, we were going to see, the end of days. The excess of supply over demand was going to be so massive, 4 million barrels a day, that would be the end of the world. And stubbornly, out there in the real world, you look at the price structure. We have a backwardated price structure. And that does not support. Yeah, while I get at the front part of the curve, some of the geopolitical uncertainty might help keep prices slightly elevated at the front. But even so, we have a backwardated structure, I think, for 6 or 7 months out. I haven't checked the numbers this morning, but probably something like that. And that would suggest that out there in the real world, the market is not anything like as loose or slack as the simple supply demand estimates would indicate. Now, on supply, estimates of supply put out by the agencies, the IEA, the EIA, OPEC, and various others, those estimates of supply are pretty good, generally speaking, because estimating supply trends is relatively easy compared to demand, because demand is found in every single country in the world, every sector, every product. And data gathering and data processing is very difficult. And I've talked before on this podcast about the fact that it is very, very difficult to rely on data from very many countries around the world, particularly in the developing world. And you can get these enormous revisions to data. So we're now in 2026. So it'll be no surprise if later this year we get significantly upwardly revised demand numbers for 25, 24. Which suddenly make a very, very make the demand picture look very different. And this
we
is
see the IEA already revising up demand in January, February.
Well, yeah, they've made small upward revisions. And this comes back to missing barrels. You've got supply, you've got your estimates for demand, you've got the stock picture, but the numbers don't add up, which is why we've got missing barrels. And nearly always, the resolution to the missing barrels issue is found by upward revisions to demand. Now, I'm not suggesting that out there are upward revisions to come which are so massive that they're going to sort of eat away at the current prognosis for the surplus of supply over demand, but they will take a chunk out of it. And I believe that there is a surplus in the early part of 2026. I think that's unquestionably the case. And between 1 million, maybe 1.5 million, something like that. But
there were some forecasts at IE Week that were putting it above 3.
Well, some people were, yes, but I don't agree with you.
I mean, they still have quite a big range, quite a big unknown.
It is an unknown, but you've got land-based stocks in OECD countries are not high. They're well within the 5-year average. I think closer to the lower end of the range than the upper end of the range. China, yes, has been hoovering up lots of cheap oil because it has a strategic objective to raise its SPR. So, there are plenty of, conflicting views and numbers out there, but the price that we're seeing in the market, yes, there's geopolitical froth at the moment. I get that, but I don't actually think it's that much. And, we'll have to wait and see how the numbers evolve. But
Peter,
does not support a glut.
Peter, join that sort of commentary in the sense of where demand may be, and the granular numbers, whatever they are, obviously difficult to nail down. But when you look at the macro sentiment and on the macroeconomic performance, Japan put out some weak numbers the other day. GDP a little bit low, new prime minister there. But China seems to still be doing macro numbers well, relatively. US still thumping along on GDP growth. Where do you see that sort of macro growth, GDP and demand outlook for the year? Better than the sort of mood music?
Well, I think so. Though I'll just start with Japan. Came in at 0.1, Sean. It was a bit of a shock. And we all understand Takechi, what she's trying to achieve and moving forward and how they're going to stimulate out. And
conveniently, it came out after the election rather than before, which may have had consequence.
Absolutely. Well, we all understand it was a landslide, and she's performed extremely well as far as the voters are concerned. And so how that moves forward, if you look at the yen, 152, 153 sort of handle, you've got very, very strong Nikkei at approach 60,000. The ramp up since April has just been enormous, down as low as 30,000, nearly up the best part of 80, 90% up. So there's the first part. Japan has got, I think, continued growth to the upside over the next couple of years. It's got fundamentally, I think that Nikkei will continue to chug higher. If you're looking at the likes of Asia as a whole, Sean, it's fairly strong. And naturally, if you roll across to India and the likes, I'll come to China in a second, it's a very, very strong growth frontier. We all appreciate the tariff situation in the US, and the US as a whole, they've got a GDP number that I think comes out on Friday. You're looking at it, well, it might even come out today, I think. 3.7% Atlanta Fed model suggested. You may even hit 4% that's for Q4 for the states. So it's bubbling along and it's firing along.
No way you're cutting rates into that, right?
Well, you wouldn't think so, but this is the pressure that President Trump's going to force with naturally his Scott Bessent and Howard Lutnick. They are going to keep the foot firmly on the throat of either Jerome Powell, or he's punted early, but certainly Kevin Warsh, and they want action and they want successive rate cuts, because the inflation target, they're at 2.4%. They've got an inflation number being released on Friday, and they believe it's going to be better than and not worse. So if there's strong growth, then they're going to argue that point moving forward, and they want to see 100 basis points or more stripped out. You've got a 2-year, Sean, that's crippled at 3.44 and a 10-year at 407. US dollar index at 97.20. It's coming under pressure to the downside as far as sell-off. And you've got an equity market absolutely on fire if you're looking in the likes of the Dow's 49.5 and the S&P 68.5. So they're strong. They've had big roll-ups since April. And China, let's leave it at that. We all understand the overhang with the property market. They've got to get growth at 5%. And we all appreciate what's going on as far as debt. So again, let's just see where it rolls in first quarter and second quarter. But it's going to be
generally
first 2 quarters.
I think generally the noise there being that there's still quite a solid demand floor in place just by GDP alone, where the bearish calls of 60 and sub 60 on Brent seem to be a little bit disregarding of that GDP health. Let's go to the survey question, which is taking on the sort of news of the day. Oil markets ignore Iran closure of Hormuz Straits. Closure, obviously, in quotations there, because it believes a deal will be done, not because they don't think Iran, they can disrupt the Straits, obviously, but the market's reaction is because a deal will be done rather than not done. Giovanni, looking at the sort of general fund flows into oil, into commodities, clearly gold and silver and the metals have been big beneficiaries over the last whatever period of time you want to go back. It's been a bumper soar, but gold or oil less attractive, or not drawing in similar funds, a somewhat discounted commodity, a safe haven perhaps as gold is at times. But your thoughts of where gold, the rising, what it tells us about where the fund's appetite is. Can oil expect to get any of that love?
So I would make the distinction that indirectly, also oil benefits from this hype in commodities. There is still some market participants buying broad commodity exposure, and with that you have also an allocation to oil, which supports also demand from there. And it's broader than just gold. It was a strong metals rally, so also industrial metal had a good performance. So it's an indirectly benefit if someone buys a broad commodity index, which contains a lot of metals, but also some energy exposure. So that's the part that can get some love from this exposure. On the gold side, clearly for me, there are two market participants still wanting to buy gold. That's central banks. Central banks since 2022, since the start of the Russian-Ukrainian war, have bought more than 1,000 tons every year, last a bit less. But this desire, despite high prices, is still there, and we still see their share of the reserves keep rising. And the latest data point was around 27% of the reserves are now in gold. In the 70s, we were at 70%. I'm not advocating we go back to that part, but clearly some central banks want to get exposure to gold with the concern on the currency markets and debt levels. The other factor is the classical investor demand. Those are looking more about the trend on the central bank policy. We already heard Peter mentioning the desire in the Trump administration to see lower interest rates in the US, and that will support ongoing demand for an investment community. And I still believe that there is more upside for gold, and we are targeting a price increase towards $6,200 an ounce.
Neil, one of the
Wow.
sorry, well, that was a wow on the gold forecast. Yeah, that's a big number. Wow is certainly an appropriate response. I wanted to get your thoughts on where we are vis-a-vis. You know, we've talked there the ample supply, and as you mentioned, i.e. weak supply outlook for the first quarter, the first part of the year is in excess of 1 million, and some forecasts even much higher. But my question to you is more about idle capacity rather than oversupply, the glut, as it was famously referred to in 2025, that never really came. But what have we learned coming out of the 9 months in 2025 of OPEC Plus continuing to increase their quotas / production supply into 26 now, when it's paused in the first quarter? They're due to meet in the coming weeks to plan beyond the first quarter. But ultimately, we lived for much of the post-COVID era with the idea, with the general lack of data, but general concept that there was 6 million barrels of idle supply in the wider OPEC Plus universe. Now it feels like technically that should be much less because they've got rid of those 2+ million cuts. But ultimately, where are we, do you think, in that data point and in that relevance to the oil markets, and so consequently offering a floor moving forward by the fact that that number is lower than maybe it was or than people think?
Well, I was never convinced that the number was quite as high as 6 million barrels a day, although nobody obviously knows the actual number, because OPEC isn't famous for transparency. But we are in a situation now where, yes, the quotas have been unwound. And what this exercise has shown us, there's a great saying from Warren Buffett that when the tide goes out, you see who's swimming naked. And what it means by that is what this exercise has shown us in the last year or so is those countries which actually are incapable, for technical reasons, of actually reaching their quotas, and certainly incapable of cheating on them. And we are in a situation now where, because of the unwinding of the cuts, we are in a situation where spare production capacity is restricted now, even as it always was, really. Saudi Arabia, UAE, a bit in Kuwait, maybe a bit in Iraq, but probably not that much. And we are in a situation where, if you believe, as I do, that global oil demand is going to continue to grow strongly for the next few years, and we see the possibility of slower growth in the non-OPEC plus countries, we are in a situation where we are back to having a very small spare capacity cushion. And if that does turn out to be the case, then yes, there is a risk of price spikes as a consequence of significant geopolitical incidents. So spare capacity is being wound down. Global investment, upstream investment in oil and gas over the last decade, since the price crash we saw that started at the end of 14, went through to the beginning of 16, upstream oil and gas investment today, or in 2025, is actually lower than it was in 10 years before, and it's not even got back to where it was before the pandemic. So we are in a situation where investment has not been high. Demand is going to continue to grow. We cannot depend on non-OPEC plus countries growing strongly forever. So this is an issue. What is spare capacity? I see that OPEC has set up yet another commission to investigate what the actual capacity is. I forget who they've hired this time to do this, but they've done this various times in the past. We'll wait and see the outcome of that work. But spare capacity is going to become an increasingly important issue going into the future, because demand is going to continue to grow and investment has not been high.
Peter, looking back to Asia, and again, the sort of demand outlook there in the immediate term, two sort of data points or sort of statements that were picked up in IE Week by fairly credible Chinese-based research companies that stated that China has reached not only peak oil demand, but also peak LNG demand. And in that regard, it continues to obviously perform, and economic growth continues. It's not peaking because of lack of economic growth. Your thoughts on the outlook for China, Asia to continue to be the engine or the consumer, the engine of growth and the consumer of hydrocarbon demand in the immediate term, medium term. It seems the tide's turning a bit. I mean, and yet we're getting these sort of global headlines from Vitol they were also declared during IE Week that they moved out peak oil demand to 2035, as the IEA did infamously last year. How do those two things coexist? Chinese telling us peak, and yet others now moving beyond that.
I don't necessarily believe that number coming out as far as China's concerned, because I'll tell you why. Electricity demand is off the charts, and that's going to only increase, I think, Sean, over the next decade, and it'll probably even blow out. I would say you'd be burning more coal over the next 15 years than what you are today. So there's the first part. And I think the overall demand picture across China and from an electricity standpoint is going to be immense.
But as you said, that's coal and renewables. It's not oil and gas, oil and LNG.
Yeah, I understand. From an LNG perspective, yes, maybe they've tapped it out, and they've done their numbers, and they're looking at their analysis and realizing that they possibly are at that crucial point as far as max. But we hear in history many times people say, look, we're at maximum demand, and then all of a sudden you keep on grinding higher, and that overall appetite doesn't wane. So I'm on that camp, more to the point that I think it will see more LNG consumption, more oil consumption moving forward. It's as simple as that. So let's see where we are in a couple of years. But if you look at some of these forecasts from the IEA, or it was in Fujairah, I think probably 2 years ago, and they said, there was 2043, I think, was the peak oil prognosis as far as world consumption, up to around about 120 million barrels a day, or it might have been 119. So I feel as though strap yourself in, Sean. The story's not over, and we've got a long way to go yet.
Well, it's certainly the end of this podcast. We unfortunately only have 30 minutes to bash around these ideas. But I do think it's worth bearing in mind the piece behind the sort of declaration of peak China oil demand and peak LNG demand rather than peak gas, which is because ultimately it's an energy security play in China. The becoming overly dependent on oil flows from countries that are controlled by Western and US powers. I think we have to look obviously at that, and that becomes increasingly a subject for many countries to be looking at, and will increasingly do so, whether that means building more storage, whether it means other things. But energy security, from the point of view of demand, is something that it will, I think, start to shape things a lot more. Giovanni Stanuvo, thank you so much from the beautiful Zurich, from Neil Atkinson from Paris, and from Peter Maguire from the beaches of Sydney. We look in envy, although I can nearly see the beach from my window. All the best, guys. Thank you again. On the day in which Iran says something about Straits of Hormuz closing, oil prices are barely moving. Thank you very much.
Thank you.
Thank you, Sean. See you guys.
Thank you.